All right, everyone, welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street for Main Street. Starting off the S&P 500, you can see we had a huge beat down this week. Just a shortened 4-day holiday trading week and 1, 2, 3, 4 days down. Markets did try to rally Thursday and on Friday in the morning, but both times it was faded, rolled right over, cut through that 200 moving average for really the first time since June of 2020. S&P closed below its 200-day moving average. The story here is the beatdown in tech. So triple Qs here lost the 200 moving average on Thursday and closed well below it today. So that is now confirmed below the 200 moving average on the daily time frame. And this is really what I've been warning about for quite some time. You guys who have been following this show for a while know that I've been saying the play pretty soon is going to be long rates short tech. The fact of the matter is these high PE, high flyer, high growth stocks cannot perform in a high rate environment, or even really a higher rate environment. That's how inflated they are and how reliant they are on the cheap debt. What stocks am I talking about? SE, look at this. Look at this pig getting slaughtered here. Crocs, not even really a high growth stock, but a stock buyback scam, a stock that's trading way higher than what their earnings suggest. Costco, a grocery store, a glorified grocery store with a 48 PE. Let's see, DraftKings, Zoom, Palantir. Take a look at how beat down Netflix got today on earnings. So look at this, trading all the way back, erasing all of not only 2021's gains, but almost all of 2020's gains as well. So coming back all the way down to the 380 handle, just an absolute beat down on Netflix. And some of these FANG stocks here are vulnerable right now. And we talked about this for a while. The FANG stocks have been holding up, the Amazons, the Microsofts, but the strongest horses are always the last ones to go, and we're starting to see that now. If Amazon loses this green bar low, it's probably going to be a $2,000 stock. It's not going to go down there in a straight line, but this is the type of environment that I've been saying will happen, and we're starting to see it play out here as rates move higher. We went into this week fairly short the market. Now we've peeled that back. We do think the market's getting a little oversold in the near term, but there probably will be some margin calling Monday morning. That could take you down to about 434. I've got penciled in here on the SPY. You've got a gap fill right here in this area, and you can see this little head and shoulder pattern here that triggered this week. The target I've got on that is right around 433, 434. So I think, if we get a little bit of a gap down on Monday, get some margin selling, it could get us to that target there. And, then maybe the market gets a bit of a bounce, but I don't think it's going to last very long. I still have us going quite lower here. And I think we're really just kind of in the beginning stages of this. But that said, we are getting into some key levels here on the market. Again, the S&P here, you got the 50-week moving average coming up very closely. So it's not likely that hasn't been tested since, again, June of 2020. So it's not likely that will break on the first attempt. It might pierce through that if we get some margin selling, but that probably will at least hold and give the market a good bid here, at least in the near term. You look at the triple Qs here, that is into its 50-week moving average, but getting close to support. You got a nice pivot here, and this area right here around 345, 344 is going to be good support as well. By the way, we talked about this MACD several times on this show, and we said, hey, look, there's the breakdown there, and that is really starting to accelerate to the downside now. But again, things are starting to get into some pretty good levels here. If we look at the Russell 2000, that one has a major gap fill that really I've been waiting for this to get into for quite some time. Then you got a little bit of a pivot below that. But Russell 2000 wiping out all of 2021 in just the first couple of weeks here of 2022, and then the Dow Jones Diamond here. So this one also, getting into this pivot here. The Dow has held up the best, and I've suggested that would be the case as the Dow is made up of 30 blue chip stocks, less of more of low PE stocks, the boring stocks. And I've said that those are the types of things that you want to own in this environment if you're going to be long and really not in cash. You want to own things like Coca-Cola, Pepsi, Verizon, AT&T, Procter Gamble, stuff like that. Some of the companies that make money and don't have high multiples, blue chip names, and those are going to perform better in this environment. Now, will everything eventually come down? Yes. But these are the types of names that are going to perform best in this type of environment. So we were talking a minute ago about rates. Let's look at the 10-year here. A little bit of backing and filling done on Friday. Again, this might need to consolidate a little bit, but ultimately this gets up to 2, maybe 2.1 if it overshoots a little bit. And then ultimately it can possibly get up to 2.4, I think. Maybe over, towards the end of the first half of the year, it's possible. I do not know if it gets up there, but I do believe strongly it gets up to 2 to 2.1 at least. And then the 30-year here, near term, again, backing and filling, but 2.3 or so, that's going to be the major target there. And if it gets through that, it can get all the way up to 2.8 to possibly 3 if it overshoots. So that's what I'm looking at there on yields. So let's move over here and let's just quickly cover some sectors. So Dow Transport's coming back in, losing the 200 moving average. This will have support at gap fill right here, which also coincides with kind of these pivots here. This is a nice consolidation base. So near term, if we go down and test that 15,000 handle, I could see the transport's catching a little bit of a bid there. XLF getting hit again. So testing this trend line, didn't close below the 200 moving average, but did take a pretty good hit. JP Morgan got smoked on earnings. This should get down to 140. Goldman, it does have some support right in this range, but ultimately I think about 320, maybe just below that, is going to be your major support area on Goldman if it gets down there. Energy here, so XLE, again, I told you guys last week about the 65 handle would be resistance, and that's exactly where it went, and we just got a nice little pullback off of that. You can see this on the monthly candle here, XLE coming back in, and again, energy still performing well. Again, with the high yield environment, these stocks are going to do a little bit better than most others. XOP coming back in and testing this resistance that is now becoming support there. So XOP maybe get a little bit of a bounce next week. OIH also coming back in. It's got some support down here, broke above these moving averages and is pulling back now. Crude, spot crude actually held up really well. I was debating whether or not to take a quick short on this trend line here that I've got going back quite a while. It actually goes back to 2015, I believe. So right here, and notice this this pattern here. So you went up here, you had a rising wedge, a little breakdown, and then a move here. You had these 3 pivots and then a breakdown. We had repeated really the same thing over the last 2 years. So this little rising wedge and then a breakdown and then 3 pivots. But I think the difference this time is the trend is much stronger in crude. And I did not end up taking a short on that, and pretty glad that I didn't, because crude held up really well considering how beat down the market got. Now, if margin calling starts to really ramp up, yes, crude can come down, energy stocks can come down, everything can come down. So, keep that in mind. Ultimately, I do think crude is in a good position, and I think it can move a lot higher. But keep in mind, if margin selling starts to really pick up, crude can get hit. It'll just be forced liquidations. The same thing kind of goes for nat gas. So we could see forced liquidations. We did have a pretty good reversal off of that 100 moving average. So maybe nat gas has another little leg down in it. And again, I told you guys I have a good buy level on nat gas, and there's a good chance that it can get there now. But that doesn't change the fundamentals of nat gas and the bull market and the energy bull market. It just means that if margin calling happens, sometimes there's just nothing that you can really do about it. Broker forces you to liquidate. You have to liquidate something to cover those margin calls. The same reason why stocks like Amazon and Zoom still sold off in 2020, even though the fundamentals were great for them with the shutdowns. They still sold off initially just because funds were liquidating to cover their margins. But anyways, let's move on here to the dollar index. So dollar pulling back last week into the 100 moving average, getting a bid off of that, and now kind of doing some consolidation here, possible bullish consolidation. If that starts to advance, which I do expect it to, you guys know I do have targets of about 98 to 99 on the dollar index, and I think it can get up there within the first half of the year, if not by the end of the first quarter of 2022. So let's talk about gold here. So gold did catch a bid this week. The one thing that I am being careful of here is the last couple of times that we ran up into an options expiration. Look at this big run up in March or May, and this one here in November, they really rug pulled the heck out of this. And so unless we see a breakout of this upper trend line and a sustained breakout of this upper trend line, I'm going to take everything with a grain of salt because, fool me once, shame on you. Fool me twice, shame on me. So I'm not going to, fall victim to that the third time, essentially. But we'll see how it reacts post options X. Same deal on silver, obviously. Nice little pop, pulling into the 200 moving average, and a little bit of a pullback again. We want to see what these metals here, platinum and palladium, same kind of chart patterns here. We want to see how they behave post options X. If they slam these things back down, well, then we know that it was just another pump here. And then lastly, copper. So this did finally get above this 451 area that I've been telling you about on a weekly close. So we did get a weekly close above it, barely, but this does open the door for a move possibly up to 488 on copper. I do not know if it can go much higher than that. I don't know if the economy can handle it. I don't know if China will allow that to happen. So just keep that in mind, but potentially a bullish close there on copper for the week. I will say about the metals, one thing, gold held up really well considering how bad the markets got brutalized the last 4 days. It was actually obviously green on Wednesday. And then Thursday, Friday, yeah, it was red, it pulled back, but compared to the S&P, the NASDAQ, I mean, it's no comparison here. So gold kind of acting as a bit of a safe haven, perhaps, as the rest of the market got absolutely thrashed. So definitely noteworthy. Again, we'll have to see how it behaves post OPEX, but keep that on your radar. One thing that did not behave as a safe haven was our Bitcoin here. So I think it's really time to put to bed, and I've been saying this really for a while now, but it's time to put to bed the theory that higher rates will be good for Bitcoin. Bitcoin has proved time and time again that it is a risk asset, and it is certainly behaving like one. And crypto certainly has the most leverage out of anything in any space really right now. And, that's really indicative of what's happened here. Big move down, bear flag, another, you had a potential bull flag here that failed, put in a bear flag, now you put in another bear flag, and now we're testing 36,000. I told you guys it was probably going to get down to 32, and I still think that's where it's got to go. Doesn't mean it can't get a bid here. You got some support here around 35, 36, but again, when rates go up, here's the thing, when rates go up because of growth, that's why, that's when you can see the big move up that we had in 2020 and even a little bit in late 2021. But when rates start going up because of inflation, it's risk off. There's a big difference. And a lot of people made that mistake and they're paying for it right now. So they got the rates up, call right, but they went long things like the Russell 2000. They went long Bitcoin. They went long risk assets, and they're getting their shirts taken right now. So very important distinction to make there. And crypto, definitely taking a hit, and it's going to get worse as margin calling starts to come in. The people that, the average crypto owner, the average owner of, these ridiculous growth stocks, they think that this is a correction. This isn't even a correction. This is a pullback. What we're seeing now is the beginning of a correction. When you actually break trend, if you just take a trend line here and, walk it back, I believe the one that I had on here for quite some time looked something like this. You can see we clearly broke trend, tried to get back above it, couldn't, tried to do it one last time, and then now you're breaking down. So now this is a correction. So, these 17-year-old fund managers who think they have diamond hands are going to find out that they really have never seen a bear market, one, and two, they're going to find out that there's no such thing as diamond hands when your brokerage is forcing you to liquidate because you're getting margin called. But anyways, I digress here a little bit. Also, just to wrap up, let's look at volatility. So VIX here getting through the 30 handle, just shy of it today. Did not make a higher high. There's one little possible explanation for that I think is possible and likely. So we had OPEX today. It could be explained that a lot of the selling was due to OPEX hedging, and institutions essentially trying to collect premium and pushing the market down for whatever reason they needed it lower. So those shorts and those hedges could potentially come off the table on Monday, and that could be an explanation as to why the VIX didn't make a higher high, as the selling was possibly not fear-based and a little bit more related to OPEX. That's just one theory. Ultimately, it won't matter because the VIX probably gets up to 40, maybe even 50. I think at some point early this year, maybe by the end of the first quarter. I do think we probably put in some type of a higher low eventually. I mean, the VIX will come back down. It's a spike index, so it will come back down when the market gets a bid. But I do think there is another bigger leg up in volatility coming. In any case, lastly, so we talked about 434, that area kind of on the spiders there. If you get through that, which I do expect you to, the next major area we're looking at is right around 420. So that's kind of what I got penciled in right now on the S&P. And ultimately, we will make another leg lower here. But there's nothing to say we can't have a rip your face off rally as shorts cover into key levels of support. Anyways, guys, take care. Thanks for watching. Leave the video a like, subscribe, etc. And I will talk to you all next week.